Hello everyone, you are all very welcome to today's webinar on financing sustainability or impact, where we'll be focusing on the opportunity and use of sustainable finance instruments in driving sustainability and impact. Today's webinar is actually the third instalment of our ESG Global webinar series, which is focused on bringing you practical insights on some of the most topical ESG issues facing you and your in-house legal team. To date, we've looked at climate and ESG related litigation. We've also looked at the future of ESG in supply and value chains. If either of these areas are on your priority list and you missed the session, please drop us a note at esgprogram@dentons.com to request a link to the recording. I do want to flag that we're taking a break over the next few months. We'll be returning towards the end of the year to unpack the dynamic ESG disclosure landscape, and we'll also be looking at your organisation's transition to net zero. So it's within that context that today's session is really all about you. We're very keen for you to get the most value out of the session in terms of practical takeaways. So I would encourage you to make the most of the chat and the messaging functions as we work through the content of today's session. So without further ado, I'm excited to hand you over to our host for today's session, Vivian Chu.
Thank you, Nate, and welcome everyone. So I'm really pleased to be hosting this session today, which focuses on financing sustainability or impact. So Nate mentioned the earlier series that we've done. So I'll just highlight here that we typically advise clients on ESG as a matter of regulatory and compliance and risks. And we also look at climate litigation and greenwashing issues. But today we will focus on sustainability or impact actually as a matter of strategy and look at how sustainability is shaping investments and financing decisions or frameworks. So I'm happy to be joined, next slide please, by my colleagues Owen McLennan and Ruben Eduardo Lujan. So I'm the lead for sustainable finance, and I'm based in Hong Kong, whereas Owen joins us from Scotland, and Ruben joins us from Latin America. And so we have a global panel here, and I hope that also would underline, how sustainable finance is a global matter. And what we will focus on is actually market trends on how sustainability is shaping the markets, and also how we will look at green sustainability issues, which are the anchor for structures or transactions or instruments. So with that, the next slide, just a kind of an outline of the sessions today. So we provide a background of the policy and regulatory environment that we see today for sustainable finance, and how that is shaping investment products for sustainability outcomes and impact investing. And we will then have a session apart on blended finance and the debt for nature swap transaction that we've done last year, and hopefully we'll have time for Q&A at the end of the session. So moving right along, and so I will do the first part. I'll cover the first part on the sustainable finance policy and regulatory update as background for our session today. I would just first lead with a framework on how we've been looking at policy and regulations. And essentially, you can consider it in 4 big areas. So we actually have seen a lot of governments and central banks policy and initiatives on climate and sustainability. That includes green investments, green policy, determining the national determined contributions for carbon, net zero commitments, and also increasing a focus on transition pathways, and even a sovereign issuance of green sustainability linked bonds and developing taxonomies. But at the same time, there's also been regulations on green disclosures, the sustainability disclosures for corporations. And separately, we have seen a lot of regulations that is targeted at financial institutions on managing sustainability risks and also on sustainability products in financial instruments or investment products. And finally, there's also a lot of emerging and evolving regulations and international standards on specific ESG issues. It could be environmental issues, carbon-related laws and regulations, and also more on biodiversity. So these are sort of the broad areas, and also social side, such as the global adoption of the UN guiding principles, business and human rights as different countries adopt their national action plan. So this is actually ongoing. And so this is something that we always need to keep in mind in terms of the landscape within which we are operating for all businesses. So on the next slide, please. So when we kind of look at law and regulations, to bring the attention to sustainable finance is actually a focus on the role of finance to manage and address sustainability issues and risks to drive long-term value creation with financial and non-financial impacts. So this is where I think it's different from ESG as a reporting and compliance matter, where it is perhaps not just the end, but the starting point to see how that would then shape investments and financing decisions. And we can look at it across the risk or returns lens, or even looking at what is the expectations on financial institutions. So in terms of risk, there are increasing regulatory requirements and expectations on financial institutions and asset managers to assess and report on climate-related risks and sustainability performance or risks in their portfolios. And also, there are financial institutions that are pursuing returns or opportunities through financial instruments or products that has focused on sustainability factors or sustainability objectives. And within this, there is growing market emphasis on transition and the move towards a sustainable economic system. And this includes a lot of conversations around transition finance, development finance, and also financing sustainable development goals or impact. Although within this, there's also been a lot of market scrutiny on greenwashing, although greenwashing is not today's focus. But at the same time, it's greenwashing that's actually driving a concrete focus on sustainability and impact as the outcome. And overall, financial institutions like the other sectors are managing societal or stakeholders' expectations on what kind of sustainability strategy, policies, and practices they have in their business and their products, and the related accountability and risk needs to be considered. So on the next slide, I would just highlight that the UN Sustainable Development Goals is sort of a increasingly common framework used to think about sustainability outcomes, because we talk about sustainability and impact outcomes, or what is green. So there is a need to define or have clarity around what we're talking about here. And the SDG is a commonly used framework on that. And the next slide, please. The other aspects of what the market has been seeing on defining what is green or sustainable is the global development of taxonomies. And we borrowed this slide here from a very good recent report by Nactisis and Nactisis Green and Sustainable Finance Hub. And it's a public website, and they have published a paper and highlighted that there is a global phenomenon now of the multiplication of taxonomies worldwide. So, for example, in Hong Kong, where I sit, just a few weeks ago, Hong Kong published the Hong Kong taxonomy for use for the local economy. So that actually is shaping what is the market's understanding, or what is the policy view of what is green or sustainable for that market or for that region, or which kind of aligned may need alignment across different jurisdictions and markets. But that's what we're looking at increasingly. And so with that, I would actually like to refer to one of the first taxonomies that we've all been dealing with, and that's the EU taxonomy. On the next slide, please, where, I I guess in the next few slides, we want to highlight where there has been these regulations, but we want to highlight where there is an emphasis on what is sustainable and what might be the underlying kind of expectations on standards here. So essentially, EU taxonomy regulations, it was intended to encourage capital investments towards climate goals and sustainable business activities. And as backgrounds, there are 6 environmental objectives, and then to be environmentally sustainable, the activities must contribute substantially to at least one of the environmental objectives. So those are climate change mitigation, climate change adaptation, water, circular economy, pollution control, and biodiversity. And there's also requirements that while contributing to at least one of these, it should do no significant harm to any of the other environmental objectives. But at the same time, there are requirements that there would be the minimum social and governance safeguards and comply with related relevant technical screening criteria. And with respect to minimum social and governance safeguards, they actually reference UN guiding principles and the OECD guidelines on responsible business conduct. So what this actually has been driving in the market is that the focus on and a need for due diligence on taxonomy alignment, and taxonomy being used as basis for financing. We see this from green loans to green bonds and other sustainable financing activities, and also sustainable investment products. And so increasingly, green and sustainable investments or taxonomy aligned investments will likely be the future. And there's also, as I mentioned earlier, the need to look at different taxonomies in different regions and where there might be a need for global alignment. So on the next slide, where we also then see that that has effect cross-border, and the EU taxonomy regulation established a standard in the sense that it is legally binding, although it is a transparency framework, it is a disclosure and reporting framework, it is legally binding, and it has implications through cross-border trade and investments. And as I mentioned earlier, it has implications for sustainable finance product development, and also for corporate ESG standards for the mapping or alignment or kind of taxonomy due diligence cross markets I mentioned earlier. So on the next slide, to focus back to corporates, what this has been driving is actually an attention on corporate sustainability reporting, because we need that the robust data from corporations in order for investors and financial institutions to have the decision useful information for their investments and financing framework. And so there has therefore been the focus on disclosures on material ESG, sustainability risks and opportunities, and that has been driving and evolving sustainability reporting frameworks from voluntary to mandatory, and different sustainability framework metrics and targets that has been developing in the market and continue developed. So on the next slide, I would just highlight specifically back to investment products, where that we have now been seeing a trend. I think the EU Sustainable Finance Disclosure Regulations, when it sort of came in operation in March 2021, with the categorization of investment products, primarily into what's called the SFDR Article 6, or the Article 8, the light green funds, or the dark green Article 9 funds. There has been in the market within the investment management industry, so this focus in terms of how they would take into account sustainability and ESG issues when investing. So for Article 6, there are funds that does not have specific sustainability focus, but the requirements do expect the managers to disclose how they consider sustainability risks. And for light green Article 8 funds, they promote environmental or social characteristics, or a combination of those characteristics. And so these products will have to disclose how they promote environmental, social aspects in the investment criteria process, and any principal adverse impact indicators will need to be reported. And for Article 9, the dark green, they are funds with specific sustainable investment objectives, so sometimes referred to as impact funds, to contribute positively. And this require disclosure on investment strategy and process for sustainability goals, and also report on principal adverse impact indicators, and what kind of due diligence data sources. And specifically, if it's a fund that seeks to reduce carbon emissions, then they need to be Paris aligned. And so that has been the framework. Although the SFDR is under review now by the European Commission, the consultation closed in December. This has shaped and this is broadly the framework that is shaping and will continue to shape sustainable investing. And later on, when I hand over to my colleague Owen, he would talk about the UK sustainability disclosures and labeling regime. But before doing that, I'll just highlight some market trends. And the next slide, please, where I wouldn't go into detail because, as Nate mentioned, we will have later sessions on reporting disclosures that's happening right after the summer break. But I think what the market is looking at now is actually the global adoption of the International Sustainability Standards Board standards S1, S2, and specifically for climate is adopted in most many jurisdictions. This is the climate standards, which adopt the task force recommendations of the task force on climate-related financial disclosures. So that's happening. And then I would just highlight that actually in the market in the next slide, there has been the focus on not just the data reporting as an end, but how the S2 standard will drive board accountability within companies, and how it would then be a matter of strategy and target setting to reduce or address climate-related risks and opportunities. So it is actually not just a disclosure reporting, and the data is not the end goal, but it would be a matter of a review of strategy and business model. And on the next slide, I would just kind of highlight that it is a matter that will be integrated alongside financial disclosure. So there's also expectation for audit down the line. And so there's expectation of carbon emissions disclosures, scope 1, 2, and 3, but not just that, but how climate risks and opportunities will affect financial position of companies in the short, medium, and long term, and that will underlie financing and investment decisions. So I would actually skip over the next couple of slides, but only to mention that at the same time, the European reporting standards is being developed as an update to the existing EU non-financial reporting directive. And on the next slide, only want to highlight that there is this concept within the EU market, which is on double materiality. Again, to highlight that sustainability and impact is something that investors do look at. And within the European markets as well, within the double materiality. And so on the next slide, I would highlight just a couple of slides on what we're seeing within the space, because actually a lot of managers increasingly integrate climate and ESG risks as a matter of their risk assessments and consideration. But following COP, there's also a repositioning where climate is increasingly regarded as an opportunity. And at the same time, there's also the COP28 declaration of a global climate finance framework, which highlight the momentum to mobilize more finance for climate. And this includes a momentum for blended finance and use of catalytic instruments. And so altogether, these are leading to an accelerated focus on transition planning and transition finance. And that means a focus on transition pathways with a focus on sustainability outcomes or impact. And on the next slide, before I hand over, some market highlights to illustrate what we're talking about here. So a few months ago, Japan issued a climate transition bond, referred to as the world's first sovereign climate transition bond. And at the same time, we had in previous sessions focused on green bonds and sustainability linked bonds. The market standard setter, ICMA, published its updated transition finance handbook last year, and also a February issue of the transition finance in the debt capital market. And at the same time, LMA is looking at further guidance around that. And on the fund side, on the impact side, a couple of highlights and examples. The Allianz Global Investors SDG Loan Fund with FMO and the KKR SDG Focus Global Impact Fund to highlight some global managers which are highlighting impact in their products. And we also have a recent launch of the Green Guarantee Company, but I'll pass that over to Owen. So with that, perhaps Owen, I can hand it over to you at this point. Thank you.
Amazing. Thank you, Vivian, for that, and good to have the opportunity to speak to everyone. My name is Owen McLennan, and I'm a partner in our asset management and investment funds team based in the UK, and speaking to you from Edinburgh. So good to have the opportunity to join this panel discussion. So like my colleagues Vivian and Ruben, I've acted on a number of transactions involving sustainable finance or impact considerations, and it's now quite a significant part of my practice. So for my portion of today's session, I wanted to firstly talk about my own personal experience, including in particular the launch of the Green Guarantee Company that Vivian has just mentioned there. I'll then talk a bit about the things to look for in terms of appointing a good impact fund manager. What does that mean? And some of the things to look out for if you're an impact investor. A lot of people may be either new to this space because all of a sudden they have a mandate to fulfill that's got an impact credential, and they may be a bit uncomfortable about the protagonists, the trends, etc., the terms to look out for. Or it might be that you've actually been very active in the investment space and a traditional institutional investor, for example, but you are new to making investments with a kind of impact focus. And so I'll talk about some of the nuances there and some of the things to look out for. As Vivian says, I'll then just spend very briefly a bit of time looking at the UK's sustainable disclosure requirements, which is effectively the UK's version of the SFDR. So if we turn firstly to the Green Guarantee Company and the GGC eligibility slide. So I was very pleased to act actually for the UK Foreign Office, so the UK Foreign Commonwealth and Development Office, in connection with its investment in the Green Guarantee Company, or GGC, which is actually the world's first Green Guarantee Company. So really, really innovative and really pleased to be part of it. So the objective of the Green Guarantee Company is to use guarantees to deliver climate mitigation projects which help deliver a net zero carbon economy, and climate adaptation projects which deliver environmental and social sustainability. GGC celebrated the launch of its operations at the London Stock Exchange in the past few months, and I was very happy to go along to that launch. And GGC will use guarantees to help borrowers in developing countries improve their credit ratings to access global capital markets like the London Stock Exchange and other exchanges. So, as I mentioned, we acted for FCDO, and Green Guarantee Company, or GGC, is receiving capital from FCDO via its Mobilist programme. So Mobilist is a flagship programme of the UK government to help mobilise capital from institutional investors into listed products with an impact investing strategy. So alongside FCDO, there was investment from the Green Climate Fund, the Nigeria Sovereign Investment Authority, USAID, and Norfund, all participants. So really a pleasure to work with that cohort and that grouping in order to help the managers of Green Guarantee Company bring their ideas to life. So GGC is going to leverage an initial $100 million from investors to provide up to $1 billion of guarantees underpinned by an investment grade rating from Fitch Ratings. Ideally, initially, rather, GGC will focus on private credit and the LSE green bond market, with the plans to expand to other major exchanges. It's going to seek to continue to raise additional capital from the private sector as it scales its operations, targeting a guarantee capacity of $5 billion or more by 2035. As is shown on the slide there, GGC's guarantee cover will prioritise green infrastructure, renewable resources, alternative energy, and clean transportation. And it's going to prioritize issuers from countries that are eligible for overseas development assistance or ODA, including, for example, India, Indonesia, Brazil, Bangladesh, Philippines, Egypt, Vietnam, and Kenya. So ODA financing, a very familiar concept for those who work in the development finance space now. So GGC recognises that guarantees are really pivotal to enable developing countries to access long-term hard currency debt financing to combat climate change. And by helping to improve the credit ratings of assets to above investment grade, the guarantees enable borrowers in developing countries to access a far bigger pool of capital at a lower cost. Really interestingly, and I think quite importantly, GGC also plans to support borrowers in delivering a high standard of reporting on the climate impact of green bonds and the loans that it's going to guarantee. So GGC will work with issuers to help build their capacity and quality of reporting reporting in order to make these bonds and loans an attractive asset class deserving of larger allocations. And reporting is something that I'll come on to discuss in a bit more detail. It's something that's particularly important in the impact investing space. So just moving on to the next slide, which identifies some of the guarantee terms, just to draw out a couple of those. So the typical guarantee will be around $50 million with a 20-year term. GGC is looking at various debt instruments, including bonds and private placements. And in terms of eligible borrowers, that's quite wide. It includes startup companies, greenfield developments, as well as private sector companies and financial institutions. So a real demonstration here of the kind of innovative work that's being carried on in this space, and a real collaborative effort between traditional private sector investors, governments, DFIs as well. So a really good example of an innovative structure that's both commercial and has a positive impact as well. If we could move on to the next slide, I'm going to kind of zoom out slightly and talk a bit about, in the course of my general practice in terms of impact investing work, what makes a good impact investing fund manager. So quite often, as I say, if you're new to this space, you'll have a budget, you'll have a mandate, you'll know that you want to make investment and make a particular impact in a particular phase, but you'll need to entrust somebody to manage those investments on your behalf. So what do you look for there? And also, if you're a quote traditional institutional investor and you're used to private equity investments, real estate investments, for example, but you really want to get into the impact investing space, but you're maybe a bit nervous around what's different, what should I be looking out for, I'm going to spend the next few minutes just looking at some of those considerations. So what makes a good impact fund manager? Firstly, well, regulatory profile and track record are really important. I think in this landscape, quite often there is sponsor agreements, there's guarantee arrangements, there's grants, there's public money, taxpayers' money. So there's quite a high degree of scrutiny from various public bodies and also from the public at large and the media. So it's really important that the regulatory profile and track record is established. In the UK, for example, that might mean FCA regulation or a track towards that, and a demonstrable track record from the team. Skin in the game is a concept that you may well have heard of. It's not unique to impact investing, but it's particularly important because of that necessary alignment of interest. So a lot of the work that happens in the impact investing space is novel. It's inherently risky, and therefore it's important for an investor to know that their interests are aligned with the manager. So you're generally looking for the manager to basically have some of their own capital at risk. The kind of rule of thumb is kind of 1 to 2% of the total funds raised would come from the fund manager. A word on transparency and cost, again, in impact investing, particularly if it's grant funding or any kind of public funds, value for money is really quite essential. So when you're quizzing an investment manager and thinking about whether or not you want to pursue a strategy with that investment manager, really important to have transparency on costs and expenses. That might include establishment costs. So typically those are borne by the investment structure and thereby indirectly by the investors. But is that capped, for example? Is there a limit on that, especially if these are novel structures? Quite often, costs can quite quickly spiral. Operating costs, again, are there any parameters around that? Are there budgeting? Is there an annual budget? What level of influence or oversight can you have over that? As well as the manager's fees and carried interest arrangements. So the management fee and the carried interest arrangement will generally recognise two of the principal ways in which the fund manager is going to be compensated for its work. So you really want to know that the manager is incentivized. Those sums are going to the right people so that there's those good alignment of interest between the investor and the manager. And then on the next slide, so things to look out for. So limited liability, as I said, a lot of these are novel structures. They're inherently risky often. So you want to know what your kind of upper limit is on your investment. So you want to be looking for a clear statement of limited liability. If, for example, you've got a very clear policy that says you cannot invest in fossil fuels, as well as being really intimately familiar with the investment objective and strategy of the fund, you need to make sure that your own policies are aligned there. And that kind of meshing of institutional policy requirements and those policy requirements of the fund manager are a really crucial aspect of impact investing work, and something that takes up much more time than it would in a kind of, quote, traditional institutional investment model. Key persons and change of control are really vital. So a lot of the time in this space, it's people, a small group of people who have come together with a really bright idea, a really amazing idea, and it's really those persons that you're entrusting with your money in order to deliver on their mandate. So you want the protection to know that if those people can't or are not able to perform their functions, then there's some kind of backup. So it might be that the investment period is suspended, or in fact the fund or the investment vehicle is simply wrapped up. And similarly, exclusivity and successor funds. In a kind of non-impacting world, exclusivity and successor funds are really, really important, because you want to know that before the fund manager goes off and raise, fund 2, fund 3, that they've got a significant way down the road in attracting the investment for your fund, and that the pipeline of investments is being presented first to your fund in priority to any others. Actually, quite interestingly, I find in the impact investing space, for some investors, this is actually a lower priority, because they're very keen for the manager to be very active in the market, to be replicating their structure, to be mobilizing, to use that word, capital from other places to kind of crowd that investment in. So actually for impact investing investors, it might be that exclusivity and successor considerations are of lower importance than, for example, reporting, which we mentioned can be really important in order to track that the various stakeholders and KPIs, be able to demonstrate to stakeholders that KPIs are being met. And just on that, I think in the impact investing space, there's very often a range of different investors with a range of different profiles coming together, looking for different returns, looking for different objectives. And it's important to be able to try and marry those up, a kind of blended finance type model. And so it might be that, for example, there's a technical assistance model, or it might be that there's a first loss component or a subordinated tranche, and all of that comes together. So it's really important to understand the different investor return profiles in any kind of impact investor framework. Equally, on the flip side, you might say, well, actually, hang on, I'm going to come in early in this scenario to allow the manager to develop an innovative track record and to be able to start deploying. And for that reason, actually, maybe it's fair that I've got a discounted management fee. So these are all really important considerations to look out for whenever you're beginning impact investing work for the first time, or looking into that area from perhaps more traditional asset classes. And I think I'll move on just briefly to talk about the UK sustainable disclosure requirements on the next slide. So this is kind of, I guess, the kind of lesser known cousin of the EU's SFDR, but has very much similar objectives. So the aim of the SDR in the UK, the sustainable disclosure requirements, is to build transparency and trust by introducing labels to help consumers navigate the market for sustainable investment products, and ensure that sustainability-related terms and the naming and marketing of products are proportionate to the sustainability profile of the product. So then I won't go through the very technical detail, but I think the important points to get across is that the UK is going to be introducing voluntary product labels. So they are different, but informed by the same principles around the labelling that Vivian mentioned in connection with the EU SFDR. So there's going to be 4 UK labels that are being introduced, and firms, UK managers are able to use those labels from the end of July this year. So that's coming in pretty quickly. So to give one example of the labels, if the assets are not sustainable now, but there's an aim to improve the sustainability, then that would qualify as a sustainability improver, and you could use the sustainability improver label. But the kind of general rule of thumb is that in order to use a label, at least 70% of the product's assets must be invested with a particular sustainability objective. And as I say, those labels can be used from 31st of July this year. They'll be accompanied by disclosures, so they're quite consumer orientated and making sure consumers have the right level of information in order to make informed assessments about whether to participate in these products. Although there should be aware there are some disclosures that will require to be made to institutional investors as well. As I say, the regime, the labels are voluntary, but if you're using particular names, for example, ESG, green or sustainable, then those words on a mandatory basis are going to be subject to the FCA's naming and marketing rules that are going to be coming into force in December of this year. So I think the FCA has tried to, as much as this is a very much UK regime, it's a distinct regime, the FCA does recognise that a lot of products are very international in scope. So it has tried to align and be coherent in terms of aligning the UK regime with the EU SFDR, for example, or the proposals by the SEC in the US. So I'll stop there. As I say, the labels coming in July and the mandatory rules coming in December. So a lot to come in the UK in terms of our sustainability disclosure regime.
Thank you, Owen. And I think I want to highlight here that actually we're all kind of been integrating sustainability into our practice, which actually is largely a transactional practice. So I think this is where, just highlight that that's what we're seeing, where, sustainability issues become, part and parcel of our transactional matters, and which we consider alongside other issues or aspects of the transaction that we worked on, such as, funds formation that Owen mentioned, but also, advising on investing in an impact fund, for example. So with that, I would like to hand over to Ruben now to talk to us about blended finance and debt for nature swap.
Thank you, Vivian, for your connection. I don't know if you can hear me or see me.
Yes, yeah.
Okay, perfect. Well, thank you again. And I would like to shift gears a bit from the previous topics and share our experience and our views on some trends that we are seeing globally in the ESG space, and in particularly the momentum that there is for blended finance, and in particularly with debt for nature swap transactions or debt for climate swap transactions. By way of introduction, my name is Ruben Eduardo Lujan. I am a partner of Dentons, and I co-lead the banking and finance practice for Latin America and the Caribbean. I'm speaking to you at the moment from Toronto in Canada. And I was part of a Dentons team that led probably the most landmark debt for nature swap transaction on record in history, which was the Ecuador debt for nature swap transaction that closed last year. And I think that particular experience will present the audience with some ideas of where this space is moving forward, and potential transactions that are coming your way that are novel, but that are being structured by international financial institutions and multilaterals. So moving forward with my session, as I said, there's a momentum and a global trend for blended finance. It's a time for blended finance. And that originated more concretely, came out of the recent COP28 conference held in December of last year in Dubai, where a group of relevant multilateral development banks committed to sustainable finance, to assume a coordinated role as opposed to acting in isolated basis, and to boost the use of climate and nature-linked financial instruments sponsored or supported by the multilateral development banks around the world. If you want to look at figures, just in the calendar year 2022, those institutions committed to close to $100 billion in climate finance deals. So we're talking real relevant deals around the globe. And out of those $100 billion commitments, $61 billion were dedicated for low and middle income economies. One of the multilateral development banks that has taken a lead in this initiative, in this trend, is the Inter-American Development Bank, which is the development bank that covers the Americas, North America, Central America, South America, and the Caribbean, along with some companion countries. And they have made a statement that they intend to dedicate $150 billion over the next 10 years. So all to say that there is interest in financing this type of investments. If we could move forward on the presentation, another of the outcomes of the COP28 meeting in Dubai was establishment, again in December 2023, of a task force comprised by the most relevant development banks and financial institutions, and that could be not only the Inter-American Development Bank, but also the African Development Bank, the Asian Development Bank, the European Investment Bank, and a task force that is led by the Inter-American Development Bank and the U.S. International Development Finance Corporation, DFC, formerly OPIC. And the purpose of this task force was to scale climate and nature-linked instruments, including sustainability-linked bonds, and the item that we want to discuss here is the debt for nature swaps. If we move forward to the next slide, I wanted just to present the case for the Ecuador transaction, because this is the transaction that all international financial institutions are looking at the model structure to be replicated both at the public sector level and at the private sector level for the development of these type of products. I won't go into all of the details, but essentially, in the case of the Ecuador debt for nature swap transaction, the idea was that Ecuador as a country had created a new marine reserve around the Galapagos Islands, and they require some form of mechanism to comply with their international ESG commitments to protect the new marine reserve. But at the same time, the country as itself was not probably in the best of financial situation to go to market under the more traditional mechanisms, including sustainability-linked bonds or new debt bonds. So they had to resort to a sort of novel structure or transaction. If we move forward to the next slide, the answer was what we now refer to as debt for nature swap transaction. And I'm going to go a little bit about the details of how this works and how that can relate to specific cases, not only for governments, but also for corporates. So it is a specialized and innovative financial mechanism. As I said, the case of Ecuador is the largest debt for nature swap transaction to date in the world. It's not the first one. Other ones have been made previously and concurrently in the Seychelles, in Belize, Barbados, and Gabon. But this is by far the most, the largest, and the structure that is intended to be replicated for future financings using this alternative, this tool that we see is going to become a trend in 2024. If we move to the next slide, so essentially, if we wanted to just picture or illustrate what these debt for nature transactions are about, I'll just illustrate it with the example of the Ecuador situation. In the case of Ecuador, they had sovereign debt, and as part of the transaction, the Ecuador acquired the sovereign debt. It was sovereign debt bonds that were listed in the capital markets, and they acquired at a by exchanging it through a new sovereign debt that was a loan that had a longer maturity and a lower interest rate. So essentially, the exchange part is canceling or annulling debt of in this case of Ecuador for new debt that is on more favorable terms, both financially and in terms of maturity. Now, how is this possible? Well, through the involvement and participation of the multilaterals that I described at the beginning of the presentation. In the particular case, we had the partial credit guarantee by the Inter-American Development Bank and by a political risk insurance by the DFC. So this is where that initial piece fits within the puzzle, because it is because of the involvement of multilaterals and development banks that you can free up, you can buy back debt, could be of a sovereign, could be of a corporate, and release funds that are then dedicated or used for the ESG commitments. In the particular case of the Ecuador, it was a set of contractual sustainability commitments associated to marine conservation and preservation in the Galapagos Islands. If we go to the next slide, I would like you to look at the people who are involved in this type of transaction. In the case of the Ecuador deal, we had obviously the sovereign, the Republic of Ecuador, through a series of ministries, because obviously there are several competencies involved when you are considering an environmental ESG project. But there's also the involvement of a number of actors, which included banks or financial institutions who broker the transaction, who go into the market to buy bonds, and who issue new bonds to the market with the new conditions. In the case of the Ecuador, it was a Galapagos blue bond that was issued into the market. In the case of this example, it was with involvement of Credit Suisse, now UBS. But as I said, also involved multilaterals, in this case, the Inter-American Development Bank, or IDB, and the US government agency, the DFC. But there's also involvement from ONGs, or ESG-related institutions, in this case, Ocean's Finance Company and the Pugh Bertorelli Ocean Legacy Project. And this is relevant because this structure, it's quite different from, let's say, sovereign or linked bonds, where the connection to the ESG use or the ESG commitments is more of a financial incentive to have a reduction in your interest or a penalty in terms of a greater interest. But in this structure, this is not how it works. There are real commitments, and they are overseen by independent, recognized OSG. So all to say that this is a structure where we see a reduced, if not eliminated, risk of typical noise and issues that we typically hear about greenwashing, because there is ongoing independent monitoring structure in place since the beginning. If we go to the next slide, I'll just give you a little bit of what was the outcome of this transaction. As I said, this transaction involved the exchange of existing debt for new debt and resulted in fiscal savings and the release of funds dedicated to ESG outcomes or ESG goals. And this is the main takeaway from this structure, because it's a structure that is flexible, that it can be used for corporates, that can be used for sovereigns, and that can be used for a number of uses, not necessarily for a marine reserve, which is probably not within the typical purview of a corporate. But in terms of what were the financial results, Ecuador was able to exchange sovereign debt for $1.6 billion in exchange for a new one for $656 million. So on the closing date, Ecuador wrote off approximately $972 million just by signing this deal. And in the future, there were savings in their debt service when you counted for reduced interest rates and longer maturities of $1.1 billion. Now, on the ESG side, that released funds that amounted to $450 million for the preservation and conservation of the Galapagos Islands, which ultimately created a significant, dedicated, and permanent source of conservation for that area of the Galapagos Islands and the perpetual protection of the marine ecosystems. So obviously, this is a huge transaction. As I said, Dentons as a firm was involved as advisors to Ecuador in this landmark transaction. Multi-jurisdictional team assisted in this globally recognized and multi-awarded deal. But the structure is intended to be replicated at different levels for different actors. And we have already heard from the likes of IDB Invest, which is the private sector arm of the IDB, that they want to replicate this exact structure, obviously in a much smaller scale, for corporate and private sector entities. So I'll leave it up with that, and I'm happy to answer any questions you may have. And thank you everyone for your attention. Back to Vivian.
Thank you. Thank you very much, Ruben. I think I hope that that's been helpful in illustrating, and it's just kind of in terms of recap. I think we really wanted to kind of showcase and highlight what we're seeing. As mentioned earlier, I think in the investment management industry. So I've actually been an asset management a lawyer focused on the financial services and asset management industry all of my career, and structuring and advising on investment funds. And now, in sustainable finance, we look at the different types of financial instruments, sustainable finance instruments, investment products. But I think critically, the market is moving to a space where, most asset managers will already see it as a given to take into account ESG issues as part of their investment analysis or risk assessments at the very least. But we want to highlight that increasingly it is becoming a matter of strategy. In fact, I think, as mentioned earlier, with COP28, that really pivotal in shifting the focus on climate risks from one of risk lens to one focusing on opportunity that is leading to a lot of change in the market. And increasingly, we see that this will be more and more a matter of strategy and economic and business model transformation, and the ISSB will lead to that. And so it becomes a matter of a strategic opportunity actually to think about sustainability for finance, and it's a strategic opportunity to kind of then pursue sustainability outcomes as the focus for finance or investments. And we also saw that it could be for a lot of managers becoming part and parcel of the investment strategy, specifically for impact funds. And overall, there is actually strong momentum and desire in the market for sustainability and for financing sustainability, which is driving innovative structures and instruments that we discussed today. So we do see that there are a lot of these conversations and structuring that we are part of that will continue to use innovative instruments or structures for financing sustainability or investing in sustainability. So that's what we hoped to have covered today. We're happy to take any questions if you have any, that you can pop them in the chat for us to address. Although, also welcome to get in touch if you have any questions after the event. And with the time remaining, I think we have just 5 minutes to go. I thought to also get maybe some, last comments from Owen and Ruben on some recommendations or suggestions that you have for our audience here in terms of where they could start thinking about structures or instruments that they might like to use or potentially see as could be relevant for them starting on a journey of having sustainability underlie their financing or investments, and not really see as an afterthought, but we focus on sustainability and impact. If I could maybe ask Owen to comment while we wait for any questions to come through.
Yeah, thanks, Vivian, for that roundup. Really interesting. As you say, I think one of the things that strikes me is how the kind of how collaborative the sustainable finance and impact investing sphere is, and the number of participants, maybe some non-traditional participants, which is really exciting, and how the opportunities then become more than the sum of the parts because everyone is participating. In terms of what you were doing and first steps, I think it's probably worth looking at investment committee procedures and protocols, etc. Does that look at investments through a sustainability lens, through an impact lens? And that doesn't need to be, if you're doing something with a very quotes kind of pure impact strategy. It's good governance now. I think, and as you're saying, it's really kind of knitted into the web of all transactions now, that the sustainability of the transactions and their impact is really something you consider across the board. So I think the way that your investment committees operate, what their standing criteria are, the things that they need to be satisfied on in order for an investment to be pursued, and whether that incorporates your legal requirements, but also some of the other considerations we're discussing today, I think would be a good place to start.
Thanks, Owen. Any comments, Ruben? I think maybe I would interject here to say that I think the intersectionality of the sustainability issues often comes into play, and also the multi-stakeholder aspects of financing, and I think we saw that both in the green guarantee company transactions, and also in the blended finance debt for nature swap transaction that Ruben talked about. So it is really relevant across sectors and across impact actors of sustainability funders.
Yeah, if I may, Vivian, so just one last thought to keep with the audience. Obviously, we only had time to kind of share at the tip of the iceberg of the transaction and the structure, but probably the main takeaway is, this is a tool that, even though I wouldn't say it's new, that it's recently created, has been around for 30-40 years, but there's a renewed interest and an institutional interest in driving it forward. There's interest all across the globe, and it's an interesting novel tool that probably it's going to come everyone's way sooner or later, which can help those who are in a particular circumstance where they might want to refinance, restructure their current debt, and at the same time they are compelled to meet their ESG commitments or requirements to stakeholders, because it is a tool that allows them to achieve savings, achieve their ESG goals, and not incur in new debt. It's essentially reducing your existing debt and meeting your ESG goals. So it's quite an interesting dual aspect to consider, and it may be interesting as a new tool for someone here in the audience to consider.
Yes, thank you, Ruben. And I kind of maybe a plug in terms of what we'll cover in the next session when we come back from summer on reporting and disclosure, is to highlight that, as mentioned earlier, the ISSB actually, is an enhanced reporting disclosure requirements for companies on climate that should shape climate recent opportunities, strategy, and business model transformation. And that actually is underlying climate finance. And ISSB is also working on its nature related disclosure frameworks and also human capital disclosure frameworks. So all of these will further underlie how we look at sustainability or impact within investments and financing frameworks. And so it is very much interlinked. And I think if you look at it positively in terms of how you can have diversified and impact focused or sustainability focused investment managers or funders, but increasingly that, as we were saying earlier, becomes part and parcel of key considerations. And so our recommendation certainly for all companies and or impact and funders to get ahead of this rather than behind. And so we hope that today's session has been helpful for you to consider the opportunities at play here. So I think with that, we're on the hour, and I'll hand it back to Neems. Thank you.
Excellent. I want to say to close today's session by saying a huge thank you to everyone for joining us today. We hope you found the polity and regulatory updates element of it practical, and that the models you've seen from both Ruben and Owen have also given you lots of food for thought around this space. I want to say a huge thank you to Vivian, Owen and Ruben for the time, thought and the consideration they put into putting together the content for today. It's really critical that these sessions are as relevant as possible for you and your in-house legal team, or indeed in thinking about the issues that you face from a market perspective. We would love to get your feedback. I popped into the chat esgprogram@dentons.com, or pop us a note here as you leave today's session on any feedback from today's session. We mentioned we're taking a little break over the next few months, but we're looking forward to seeing you all back at our next upcoming sessions towards the end of the year. That concludes our session for today. Wishing you all a great rest of day, and thank you for joining us.